Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss about CAIIB paper number 3, that is a new subject, Advanced Business and Financial Management. Important questions, part 5, for revision purpose. We are starting JAIIB classes for June 2023 examination, for October 2023 examination from first week of June, and revision classes for JAIIB June 23 exams are also in progress. Interested members are requested to contact on this number. Question number 1. These are the very useful and important questions for last minute revision before examination. Best indicators of business risk, that is called best indicators of business risk. Operating leverage. Operating leverage formula, contribution by earnings before interest and tax, EBIT. Operating. Best indicator of business risk, operating leverage. Sales 2 lakh rupees, sales 2 lakh, PV ratio 40%. PV ratio formula, contribution by sales into 100. Contribution by sales into 100, so 40. In this case, 2 lakhs into 40%, that is 80,000 is the contribution. Contribution is 80,000. 2 lakhs into 40, directly 80,000 is the contribution. And operating fixed cost 40,000. So what is the contribution minus operating fixed costs 40,000? You will get EBIT 40,000. Contribution 80, fixed cost minus fixed cost 40, you will get earnings before interest and tax 40,000. So what is the operating leverage? Contribution by EBIT. So 80,000 by 40,000, operating leverage is 2. This can be best described as business risk. Question number 2. Question number 3, multiple IRR. When at the time of capital investment, you have to calculate multiple IRR. When cash flows from the project are not in the desired direction, reverse direction means cash flows sometimes they are getting, some years it is getting profit, some years it is getting negative means losses. At that time the management has to calculate multiple IRR for the project. Multiple IRR means the cash flows are uneven. Some years it is getting profit, some years it is losses. That is called a reverse. Most suitable approach for determining value of the intangible assets. Valuation of assets lo most suitable intangible assets. What are the intangible assets? Goodwill, patents, copyrights, trademarks, mining rights. These are all intel. How we can calculate the value? By relative. Relative means same organization and other organization. How they are calculated? Relatively, comparatively other organizations may, what is there? Relative means comparatively in other organizations. Relative. Most suitable approach for determining the value of intangible assets. Relative approach. Very important point and very difficult also. Relative approach. A warrant. Warrant means some companies they are attaching the warrant as a coupon to the shares. This is just like a coupon. The warrant is relatively long term. The coupon is for 5 years. The warrant holder is having a option right to buy equity shares in that company at a predetermined price over a specified period of time. It may be 5 years, 4 years. So, warrant is a right which is attached to shares long term. Normally, the option warrant period is 4 to 5. Some company they are giving 10 years also, 5 to 10 years. The warrant holder is having a right. Option means right, but not an obligation to buy equity shares which is beneficial to him at a predetermined price which was decided by the company over a specified period of time, that may be 5 years or 10 years. That is. So, a warrant is relatively long term option to buy shares equity at a predetermined price. 6. A convertible bond with par value. Issue price is 500 rupees. Face value of the bond is convertible bond 500. Sold issued price is 520. 500 convertible bond issued at 520 to the investors. And each bond is going to be converted into 20 shares. The 500 rupees bond is going to be converted into 20 shares. What is the conversion ratio? 500 divided by 20 shares. So you will get 25. You will get 20 shares for each bond, means each share value is 25 rupees. Conversion price, what is the price? 500 rupees bond, they are giving 25 shares. 20 shares they are giving. Each share price is 25 rupees. 25 rupees into 20, 500. So, conversion price of the price is 25 rupees. 25 rupees. 7th point, cumulative preference shares. There are various types of cumulative preference shares. The cumulative preference shares, the preference shareholder, in some periods, they are not getting the preference dividend because of losses in the company. These unpaid dividend cumulative is going to be, unpaid preference dividend is going to be cumulative for next year. That is called cumulative. Any 1 year preference dividend was not paid, the dividend is going to be cumulative for the next year. That is called cumulative preference shares. And even after 2 years, the cumulative preference share dividend was not paid to the preference shareholders. Normally, preference shareholders are not getting voting rights, but 2 years preference dividend was not paid consequently, means automatically they will get voting rights and they will participate in all meetings. This is about the cumulative preference shares. Question number 8. A taxpayer in India may generally carry forward business losses for a period of up to 8 assessment years. So, any company, they want to forward the business losses up to 8 years, they can carry forward, subject to years succeeding the assessment year in which the loss was first computed. Means first they have to decide the loss in a assessment year. After completion of that period, they can carry forward the business losses, and means they can adjust these losses from the profits of the company up to 8 assessment years. This is the loss making companies. Question number 9. Low liquidity would be negative impact on the demand for real estate. What is the reason for negative impact? Means not people are not interested in real estate. Reason is low liquidity. If they want to sell, they cannot get immediate buyers. Low liquidity. Low liquidity means immediate buyers are not available to buy the real estate. That is one of the disadvantages in the real estate. Low liquidity. Question number 10. Types of startup financing. Types of startup financing. Startup financing is the new mission now. Startup financing. Startup financing under priority sector, banks can give up to 50 crores for each unit under startup. startup finance. What is the startup unit? From the date of registration up to 10 years in any one financial year, turnover not exceeding 100 crores. From the date of registration 1 to 10 years in any financial year, turnover not exceeding 100 crores, that can be treated as startup unit. How they are getting finance? Debt financing means term loans from the banking. They are issuing bonds from the market, that is called debt for fixed assets. And equity, they are taking equity, they are issuing equity shareholders for investors also. And grant, government grant, they are also getting state government, central government, CAIIB, other organizations, grant in aid support from the government. So what is the meaning? One is debt finance, equity finance, and grant in government finance, grants, government grants. This is types of that. 11th question, in which of the following fields India's startup movement has expanded greatly in recent? E-commerce. So many e-commerce units has established and they are doing wonderful work in the startups. E-commerce. Question number 12, artificial intelligence. This is also coming in a big way. Artificial intelligence. Who first coined the term artificial intelligence means John McCarthy. John McCarthy, a professor who first coined the term artificial intelligence in 1956. Artificial intelligence is also coming in a big way as of now. Dear viewers, these are the 12 questions for today. We are continuously updating. This is a new paper, Advanced Business and Financial Management. Hence, that's why daily we are uploading 10 to 12 questions daily. Thank you very much for all.